Now we're going to look at disclosures. So one of the things that those doing December and March year ends need to do, if you still have clients that haven't finalized their December year end accounts, for general purpose accounts, you need to do this. For special purpose, I would still recommend doing it from a transparency perspective. You need to note the impact of COVID-19 on your clients. So an example could be XYZ company is currently aware of the disruptions of COVID-19. We have taken the following measures to deal with it. All meetings are now held electronically. We have applied for state and government funding and have been successful. We've negotiated cancellation or waiving of certain fees. We've reduced the hours staff are required to work, therefore reducing payroll. We've closed the office with staff working remotely. We've negotiated rental reductions. Those are just some of the things that you can say in terms of the impact. Then what you need to do is conclude on that impact. And I've put there some template wording that we currently use for some of our clients, so feel free to copy that. It's basically stating that all of these impacts that I've said, they're not affecting us in a material way, so they're not what's called an adjusting event. We haven't changed our balance sheet and P&L as a result of these impacts. And while we don't know how it's going to continue in the future, we still feel that what we're doing at the moment is adequate. Okay, the next area that is going to be an area of focus for all auditors is going concern, especially for general purpose, but still very much so for special purpose financials. So if your entity has any indicators of uncertainty, trading losses, negative equity, then you as the company need to show evidence to the auditor that you've assessed the reasonableness of the going concern assumption. So this is where you as the accountant can really be proactive and help your clients, especially if you're aware that they do have going concern issues. They need to prepare really robust cash flow statements, and this is something that you could potentially assist them with. One thing they need to be considering is all the different impacts, and the cash flow has to be not for 12 months from year end, but 12 months from the date the audit is finished. So we're looking likely that a cash flow should extend up to, say, October or November of the following year. You need to consider all sorts of factors, and you need to document the assumptions that you're making, the key assumptions that you're making in your cash flow, because your auditor needs to look at those assumptions and be able to audit them. One thing to be aware of in particular is debt recovery and the impact on trade receivables. There are a lot of people that are delaying payments. If there are any potential bad debts, from a tax purpose, you want to be writing that off before 30 June. So you really need to have a look at those clients that are impacted by cash flow and from debtor recovery, and get them starting this process now in June, because they need to actually calculate their provision for doubtful debts, but they also need to show evidence of the follow-up action that they have taken before they write off that debt. So they need to have contacted their clients and established payment plans, taken them to debt recovery if that's an option. So you can't just simply write them off. So these are things you just need to be mindful of.